Since we're on the subject of financials, and that's where all the action has been, let me welcome on board Shweta Daptardar. She joins in, Vice President, Lead Analyst, Diversified Financials at Elara Capital, joining in on the show right now. Shweta, hi, thank you. And I know we rushed up your morning, but glad that you could make it. Wanted to address all the news flow around this. Tell me, Shweta, how is it that you're reading into RBI guidelines? Firstly, for gold financing, and how much of an impact is it going to, have on overall disbursements?
Hello, good morning. Thank you for having me. Essentially, these RBI lending norms, which have been sort of relaxed, especially for gold loan and gold financiers, apparently also bodes well for microfinanciers because largely the dilution of the from the draft guidelines now towards relaxation is happened in the lower ticket segment, which is below 2.5 lakh ticket segment, where even microfinance borrowers are proactive. So a couple of things which bode really well, primarily for gold financiers. One is revision in LTV from 75 to 85% for the loan sizes up to 2.5 lakhs. Also lower credit appraisal for loans up to 2.5 lakhs, or rather stringent processes will be applicable only for loans above 2.5 lakhs. And last but not the least, while the LTV consistency has to be maintained throughout the tenure of the loans. But given the fact that the LTVs per se have been revised higher, so this will have positive bearing on credit offtake on the gold loan side for these financiers. And also because of lower appraisals and less of stringency in terms of processes, that would directly imply that turnaround time will be quicker, faster, so net very positive as far as gold financiers are concerned. I think it will also have certain positive impact on the microfinance because there has been overlap across these borrower segments.
Hi, morning. This is Snehi also joining in. Let's talk about the regulatory part of this new framework that we've seen. The draft had other recommendations as well as the likes of monitoring of the end usage of loans periodically by respective lenders. Now, lenders will make an annual disclosure of the loan breakup in terms of their ATS, LTV, and the percentage of GNPA. What are you making of this tightening of regulation on this front?
Yeah, so like I said, the tightening or the stringency is largely for loans above 2.5 ticket size. And see the latest data that has been incoming for past one quarter, there has been certain delinquencies that have been observed in higher ticket segments than the lower ticket segment. So I think that's where this is pivoting towards slightly higher loan ticket size. Having said that, like mentioned, while the LTVs have been revised on the higher side, this will have positive bearing on the disbursements for gold financiers, and only the monitoring of priority sector loans have been slightly on the stringency side, or those processes have been sort of tightened. But otherwise, net, this looks positive and bodes well for both Muthoot and Manappuram as well as IFL gold loans.
Shweta, how much does the RBI's revised qualifying assets criteria for NBFCs, that is microfinance, from 75% to 60%, will help the sector to diversify and expand its asset and improve the financial position of the MFIs?
So yes, you're right. So definitely, see, things have been sort of leading in a very positive direction, even for MFIs. But we have to be cognizant of the fact that the business metrics are still not holding up well. So in the MFI space, now the focus has moved from credit quality challenges to credit growth challenges. Even if you look at the latest CRIF data that was released, say a fortnight ago, it clearly highlighted that the 3,80,000 odd crores segment, the microfinance segment, has seen decline sequentially in terms of loan growth. And I think at least for 2 quarters, the business pressures sustain because of time and again regional challenges. Also, MFIs have been preoccupied with strengthening their balance sheet in terms of near risk or inviting near troubles on the balance sheet. So, and we have to be also cognizant of the fact that almost 60,000 odd crores of total business has been wiped off of the microfinance overall gross loan portfolio in this down cycle. So recouping that is definitely going to take a while. But yeah, having said that, the incoming data is slightly turning positive. But apparently, this is not sufficient enough to call out on whether the microfinance challenges are completely behind. I think there's still time for that.
Okay, and also help us understand what you are making of this repo rate cut and CRR cut that we've seen by the RBI. Because if you take a look at their inflation projections for Q4 FY26, the projection is 4.4, which is slightly above our 4% band. Do you somewhere believe the RBI has already anticipated this front loading to lead to surplus liquidity situation in the economy, and perhaps there could be some rate action when we get closer to Q4 of FY26?
Yes, so you're right, partially. So apparently, RBI has done a lot of front loading in terms of liquidity push and simultaneously a massive repo rate cut. I think both these situation bodes well for the credit growth scenario in the system, and I think this largely holds more positive for non-banking financial companies because this would also mean now banking system would be becoming slightly more sort of supportive in terms of funding towards NBFCs. So in the interim periods, at least I think for 1 or 2 quarters, things really look up in terms of credit growth, both for banks and NBFCs. Having talked about inflation estimates, which have been slightly put on the higher side for the forthcoming periods. So yes, I think a larger part of rate cuts now are behind. And as RBI has also maintained a neutral stance, and depending upon the incoming data, the further steps will be called out for. But as on today, at least for 2 to 3 quarters, NBFCs look slightly in a better position than what they were before this monetary policy. Having said that, we are positive on NBFCs, only the ones which are strong on balance sheets in terms of liquidity and which are posting or are sort of poised to post a strong earnings profile. So I think we'll put bets on on these kind of sets.
So what's the list like? I mean, we were just wondering whether there's going to be that, customer shift from companies having a higher reset period, like say an LIC Housing Finance, into ones which have a lesser reset period. What's the list of your preferred list of banks and NBFCs now?
Yeah. So valid question. So from the perspective of the monetary policy, especially, so certainly repo rate cuts on a massive scale bodes well for consumer financiers, gold financiers, basically small tenure ticket size loans, even housing financiers for that matter. And of course, depending upon what the liability or the asset mix is. But having said that, this looks positive more for Bajaj Finance. We like even now definitely Muthoot Finance after the gold lending easing of norms. We also like SBI cards at least for the interim periods, although they will definitely face challenges in terms of asset quality. And we also have our bets on affordable housing finance space. So I think yeah, for at least for next 9 months, NBFCs, given the kind of liquidity boost in the system, definitely stands positive.
Thanks for joining us. Great chatting to you this morning, and thanks for providing some clarity on what all of these regulations that we've heard on Friday could mean for the entire financial space. On that note, we'll let you go. But while we are